Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Join us as we help explain exactly what having a solid financial plan means, as Jake draws from years of experience in helping hundreds of individuals get financially organized and focused on their goals. We hope you find Upticks educational, entertaining, and shareable. Now, on to the show.
Welcome back to Upticks. This is episode 192, How to Invest in Stocks with Cory Bittner. Cory, is that back-to-back episodes?
I think so.
You know, don't take this the wrong way, but my pipeline's dried up a little bit. I had this thing going with bringing on all these outside guests, and time snuck away from me, but I need to get back out there. But I love having you on the show. You were on the original episode of Upticks number 1. So if any of our listeners or viewers want to go all the way back to the archives when Cory and I were mere amateurs, check it out. You might get a good laugh.
You know, Jake, I went from being on episode number 1 to a last resort guest, but I'll live with it.
That's true. That's true. This thing has evolved. I mean, this is my 192nd episode. Went from you and I to just me and some guests, to just me, to me and some guests. So I like the guest approach. I think people get more out of it. And I know you have your own show, so you're a busy guy. And so I appreciate you carving out some time to be on my show, Upticks. And your show is called In the Money Insight. It's on the same platform. If you're not already subscribed, please do so on YouTube or your favorite podcast platform. Cory has his own podcast. I have mine, and then we share the YouTube channel. All right. So for today's topic, Cory, I've been having more and more real client conversations around some of the individual stocks in our portfolio that we manage for clients. So for today's topic, I wanted to talk about how we invest in stocks for our clients and maybe give some broad tips out there when people are maybe dabbling on their own. And so I think just to kick off the show, though, I want to talk about maybe why we invest in stocks. So if somebody asks you, Cory, why do you buy stocks for me? How do you answer that?
2 reasons. 1, to keep pace with inflation over the long term. We have to keep that in mind. I'm not talking 6 or 12 months. I'm talking decades. And then secondly, is for growth and appreciation.
Right. So to kind of re-explain that, so number 1 would be to maintain your purchasing power, because you've got options, right? So the idea is that people invest because ideally they want to get a return on that investment so that they can ultimately maintain their lifestyle as the cost of goods and services grows. And then, like you mentioned, you want to grow your capital and you want to generate income from it as well. Now, fundamentally, we like to invest in publicly traded stocks because we feel like we are helping spur economic activity by allowing these companies to offer more goods and services for their customer base. So if XYZ stock is a fast food company or whatever, and you invest your money in it, well, now they're going to take that money and maybe go open up another store or hire more people, right? Or generate more hamburgers or whatever. And so that's why we like fundamentally investing in companies, because we're helping also spur on economic growth. And from a personal standpoint, some people have enough money just to leave it all in cash their whole life, and kudos to them. But most people, they need their nest egg to grow in order for them to not run out of money. And that's why we use stocks. Now, when you're investing in stocks, it's not as simple as just picking what your neighbor's brother's cousin's dog's sister said was going to be good, or what CNBC says is good, or even what your coworker has in their portfolio and they think is good. I mean, there's a lot more into investing in stocks than just reading the news and saying, hey, I think ABC, I heard they're coming out with some new 3D digital printer, blah, blah, blah. Mm-hmm. Go put my money in that, Jake. That doesn't necessarily mean that new technology is going to make money. So you've got to be careful with that. And do you want to comment on that at all, Cory, from your standpoint on investing in individual stocks?
The only point that one thing I would add to that, Jake, is if we're investing in a stock, we're investing in a publicly traded company that is run by people, right? So you're investing in management teams and you're investing in people that are driving the vision of that company, as opposed to just, purely an asset that you buy for the purpose of hoping it appreciates in price, like gold or Bitcoin, right? Something like that, right? So you're investing in people, but having the appropriate expectations for what that looks like. I think that it's important for people to understand that you could buy a stock and it could drop, you could buy a stock and it can go straight up, but that if that happens over the course of a month or 3 months or 6 months, that really is such a short period of time in the grand scheme of things. So evaluating what a company's doing and how they're performing over a very short-term basis can be a flawed way to look at it.
Right. That's a very good point. And I think too many people look at it as gambling, or like you mentioned, we could buy a stock and it go down, unfortunately, as soon as we buy it, but that doesn't mean that fundamentally it's bad or that you want to go sell it right away. I mean, there's the adage, sell high and buy low, but you want to be careful because there's not only is there a price involved, but there's this fundamental underlying holdings of a company that actually, if we buy it and it drops, well, now may be time to buy more of it. And I'm going to go into that right now, actually. I think that's a good segue. And so I'm going to share my screen and I'm going to go over probably the most popular chart that we go over with our clients, Cory. And can you see this okay on your screen?
Yes, I can.
Okay, perfect. So the way you read this, and Cory, I know you know how to read this, but for our audience, the way you read this is every column represents a year. And it starts on our chart from 2002 all the way out till 2021. Now, if you notice, the title of this chart is A Disciplined Approach. I think that's very important that we have that as a title of this chart. Now, on these columns, every colored box makes up a main style of the broad market. So you've got large cap, which would be big blue chip companies that are common knowledge to people. Real estate are publicly traded real estate companies. Small caps, again, are like they imply smaller. This is developed international. Then we've got high yield, which would be like high yield bonds, for example, maybe a little bit risky or a junk bond. Cash, US bonds, US fixed income. Emerging markets, this would be like China or Australia. And then global bonds, right? So bonds not in the US. And what this chart does, it's called the Calan. The Calan Institute is who publishes this, not you and I. But what they've done is they've ranked from top to bottom each one of these categories from the best to the worst, and they put it in color and they rank them every year. And the whole design of this chart is to show you that things cycle up and down or in and out of favor. And you could look for a pattern, but there is really no, I mean, it's somewhat randomized. I mean, there's macroeconomic events that are driving this, but you can look here at the orange. So that would be like China and Australia and India. They've gone from the best to the worst, to almost the best, to the worst, to the best, and so forth. So if you just put all of your money, let's just say you put it all in large caps, because that's all you know. Well, you can see if you do that, you're just riding a wave up and down. And so what we do for our clients is we put a certain percentage in each one of these boxes that most importantly aligns with their financial plan. And it totals 100%, right? So it's invested 100%. And the idea is that anytime one of these boxes grows to be more than 5% of whatever that fixed target is for our client, we sell what's done well up here, the extra 5%, and we go down here and we buy what's now low, which again forces us to sell high and buy back in low. Now, what's critical in this, Cory, and I think people get lost in this, and it's a byproduct of us being so transparent for our clients, is that they'll want to say, well, I don't like that real estate stock. Get it out of my portfolio, right? Well, when they do that, they have to recognize that they're messing up the whole infrastructure of the entire investment thesis or philosophy. So when we're buying individual stocks, yes, we're looking at them individually on a fundamental level, But more importantly, we're looking at how does holding that stock impact the portfolio. So everything. Right? So it's like driving a car and saying, I don't need the back seat because it's only me ever in my car. So you would have tell Ford, Cory, take that back seat out. I never have any passengers. Well, that'd be kind of silly, right? Why would you drive a car around with a just metal for the back seat? You had no back seat. Doesn't really make sense, right? Or why would you drive a car with 3 tires, right? So, and maybe some people do, or that's a trike, I guess, but that's another conversation. But my point is, you not only do you want to be rebalancing and selling high and buying low based on the math, you don't want to start pulling things apart because maybe you've got a stock that's low and you're like, Jake, why is that in there? Well, it's down right now, but it doesn't mean it's going to be down forever. And so you got to realize that being diversified and owning individual stocks, we actually aim to have some up and some down all the time. And that's part of being diversified. And I know I've spoken a lot, Cory, and I'm sure you want to chime in here, but can you elaborate on any of this on the individual stock and maybe the Kalan chart while I've got it pulled up?
Yes, Jake, you just read my mind and that I'm chopping at the bit to speak here. What I want to talk about involves everything that you just stated, but thinking about the laws and the rules and the fundamentals of asset allocation and diversification, right? So when we're going and investing capital for our clients, our intent is to achieve a target that fuels their financial plan and makes their financial plan work. But when we're allocating capital to different asset classes, all of the boxes that are highlighted on this, a specific percentage is allocated to each one based upon historical return and historical risk associated with that asset class. And asset allocation is blending multiple asset classes with different risk return profiles and historic data in an effort to not have someone's capital concentrated in any one type of investment. Because conceptually, if I went and bought 4 different investments, let's just use mutual funds as an example. If I went and bought 4 different mutual funds, I may feel like I'm diversified, but if those mutual funds own the same investments, I'm not.
Right.
So if you, back to your point, really originally of what we started talking about here, if we pick apart the portfolio and we start selling certain companies because for whatever reason, and replacing those with something else, we could very well end up with, if we're always chasing whatever's performing the best. One thing I noticed on this chart, shame on me for not noticing this before, Jake, but looking at this across from 2002 until 2021, there's some that are close, but there are not any years where this top performer has been the top performer for more than 1 year.
Good point. That's a good observation. So it's almost foolish or stupid to go and put all your money in this blue one, large caps, and even though theoretically it could happen again, but you're chasing it and it just shows you, again, history is no predictor of the future, but it hasn't happened in the last, almost 20 years that if you think whatever's hot or in favor this year and you go start chasing it and putting your money in there, according to this chart, it probably is not going to work out in your favor. You might make money, but you're not going to make as much as you probably could have or should have. And many times, Cory, it goes, you can see here, from the best to the worst. Very next year, very dangerous, right? So if you loaded up on emerging market stocks in 2017 and put all your 401k in that mutual fund, and then you stand to lose a lot. Very good point. Very good observation. So go ahead.
If I may add one more thing to that, though, the intent when we construct the portfolio is that we own some things zig while other things zag, and that is very much by design. And the reason, the why, right? Why do we construct the portfolio that way? Why is that important to us? I think if we take a step back and remember why we do that, by blending different asset classes together to achieve a target, to understand what the risk profile of the portfolio looks like, the whole point in doing that is to help soften the blow when things get ugly in the market, to ultimately allow investors and clients to stick to the plan long enough to allow it to do what it's designed to do and to let the money do what it's supposed to fuel that plan.
Right, exactly. And so the big lesson here is that, yes, we love buying individual stocks, but there's more that goes into it than just picking one from here, one from there, one from there. We use that Kalan to maintain diversification. So you don't want to just start picking pieces out of it because you don't like that it's down. I mean, that's foolish because again, I just showed you what goes up must come down and what goes down goes up. And so things cycle. So you've got to stay patient. And just like the chart implied, you've got to stay disciplined. And again, we use math to determine when we buy and sell. You're not relying on my gut feel or Cory's or our traders, and it works. And again, this process is derived from the University of Pennsylvania, where both you and I, Cory, have gone to study, and they've been teaching it this way since the 1950s. So we think it's a wise way to manage money. We implement it with great detail and discipline for our clients. And I just, I want to keep providing that transparency to our clients, but I want them to make sure to know that it's probably not a good idea for them to call in here and suggest they start pulling pieces apart of their portfolio just because they're frustrated by seeing something down. Because again, that's like taking the back seat out of your car because you never have any passengers. It doesn't make sense. Or taking flour out of a cake, right? It would be an awful cake. So you say, I don't like flour, Cory, but make me a cake. Okay. I guess they do have flourless cake
is a thing today, but I don't know how it tastes.
But you know what I mean? Yeah, you know what I mean.
do.
It's like having an all-American breakfast without eggs. Well, it's probably not an all-American breakfast without eggs in it. You can do that, and that's fine on your breakfast, but don't do that with your nest egg. Don't do that with your portfolio, your long-term portfolio. So again, we love the individual stocks, but you got to understand, more importantly, it's how do they work together in the portfolio than just alone on their own.
Yes, and a perfect example for people to think about is the largest e-commerce company in the world. I'm not going to name any names for compliance purposes. I don't want anything to be misperceived as an investment recommendation.
Right.
But the largest e-commerce company in the world that we all know, when that company started trading publicly, there's all kinds of stories that CNBC and everyone else will run on. If you invested $10,000 in that company the day that it went public, how rich you'd be today. But it's important for people to know that in the first 10 years of it being publicly traded, it went from its peak and it had a 90% drawdown twice.
Wow.
So we need to remind I think about this too, right? If the reality is, if I invest $10,000 in XYZ company the day it becomes public, I could be worth so much money today. But would we have hung on to it during two 90% drawdowns? Probably not. Especially if you started picking apart a portfolio because you weren't happy with how something was performing in the short term.
Right. And people that did hold on to that company that you're referencing has probably made a huge return by staying disciplined and patient.
Yes.
So what we do at Falcon Wealth Advisors, so again, we're looking at the fundamentals, the growth, the income opportunity, and then we're piecing it into the overall portfolio. So there's a lot more that goes into it than just saying, I don't like that one, it's down. It's not that easy. You shouldn't be managing money that way. And we don't manage money that way at all. It's far too serious and important to go in there and start ripping things apart because you're just messing it up. But don't have that flourless cake. Don't have that absent backseat in your car. Let it work. Let diversification and the portfolio construction work in your favor.
Eat your eggs with your all-American breakfast.
And eat your eggs with your all-American breakfast. Good. Cory, I know we're filming this midday, but we're running out of time here. Get anything fun to share with the audience or anything new?
Not too much. I'm looking forward to the latter half of next week. My wife and I planned to take a trip that I neglected to actually plan. So we're going to take advantage of the couple of days that we planned for a little staycation. I think we might take a little road trip somewhere, maybe stay at a hotel, just hang out, spend a little bit of time together, and enjoy the city that we live in that we love.
So you're just going to drive in Kansas City. Do you take your dog?
I think so. We haven't figured it all out yet. I imagine some of it will be spontaneous.
I've never done a staycation.
Me neither.
Well, I'm gonna have to bring you back on the show and let me know how that goes.
Yes, and someone told me that despite the fact that I didn't plan a vacation that I said I would, frankly, that if the relationship with my wife is an important one to me, then I better go ahead and take the time for us to spend some time together.
Yeah, that's important. Happy wife, happy life.
How about you? You've got some fun stuff on the horizon.
Yeah, I'm heading to New York. So as of this pushing out, I'm sure I'll be back by then, hopefully. And got the Falcon Wealth Advisors tour, golf amateur tour starting up. It's a pretty cool amateur tour that you and I, Cory, have sponsored this year. So I'm real excited about that. Actually, that's kicking off. So I've got a couple tournaments coming up with that. It's still cold. It doesn't feel like golf season to me yet, but hopefully it warms up here quickly and I can get out there and practice because I don't think my scores are going to be that good, but we'll see. I haven't got a chance to practice as much as I like to. So, but yeah, that's new. So Rachel and I are going to New York. We're going to go see Macbeth on Broadway, do some shopping. We donated a ton of clothes. I mean, an obnoxious amount of clothes to Goodwill. The only problem with doing that, Cory, is that now my wife wants to go replace all those clothes she donated. So New York's going to be a little pricey trip, but it'll be fun. We're going to have a good time. I might buy a new suit and maybe some jeans, but I think she's going to be doing a lot more. Good. Even though she's not a big shopper, so I'm not that worried about it, but it'll be interesting to see how much she buys.
I'm not a big shopper either, but when I go to New York, it's like I got to shop a little bit.
They got nice stuff there.
Yep.
So, and I get it online, but there's something, I'm pretty old school. I'd rather buy a lot of things, and I can't buy a suit online. Jeans, you kind of want to try on too. Yeah, I guess unless you know the brand you like. But so yeah, that should be fun. We're looking forward to it.
Good.
So, well, perfect. Well, thank you again for joining me. I know that's all the time we do have for you today. Thank you all for tuning in. Please feel free, subscribe, like, share our content. And if you have any suggestions for any topics for Upticks, don't hesitate to send me a quick email at jake@falconwealthadvisors.com. Cory's is simply cory@falconwealthadvisors.com as well. Thank you again, and we hope you have a great week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, falconwealthadvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.